Welcome back to my channel, guys. Just kidding. Welcome to episode 1 of the B2B web series. For those of you who don't know me, I'm your host, Aaron Westhuizen. That's Aiden, who plays a D with an R, Aaron. In my day-to-day, I am an investment professional with 5 years post-qualifying experience in investment management and corporate finance. I did my articles at a Big 4 firm in Johannesburg, and I was also an academic trainee in my hometown of Gqeberha. Well, enough about me. The purpose of today's episode is to break down something complicated that every accountant loves: deferred taxes. Now, before we jump into the deep end of deferred taxes, let's take a step back and get our feet wet with the basic principles of IAS 12.
Okay, so today we'll be talking about deferred tax. But before we get to deferred tax, let's start at IAS 12, which covers income taxes. Let's just call it IT. So, what does IAS 12 do? Well, it prescribes the accounting treatment for income tax. Now, when we look at that can then arise as a result of current or future consequences. Okay, so it can have current or future consequences. When we talk about current, well, that can arise as a result of transactions or events. Not nasty C and coffee. So when we look at transactions and events, well, that will then affect our statement of profit or loss or our statement of comprehensive income. And when we talk about future consequences, well, that can have either a positive or a negative impact. So when we talk about that, well, that then affects our recovery. So we'll either have a positive recovery or a negative recovery, and depending on that, essentially gives us deferred tax. And that's what we'll be talking about today. So let's talk a bit more about deferred tax before we jump into today's example. So what is deferred income tax? Well, quite simply put, it is your temporary difference times your tax rate. So, tax rate, that's easy. South Africa, 27%. Now, what is our TD? Well, our TD is our CA, carrying amount, which is accounting, minus your tax base, which is tax. Now, if we get positive, well, then that is a deferred tax liability, also known as taxable. And if we have negative, we have a DTA, and that is deductible. Okay, there are, however, 2 exceptions to recognition of deferred tax. Number 1, it's the initial recognition of goodwill. Number 2, it's the initial recognition of an asset or liability that doesn't impact accounting profit or taxable income. Okay, so key to remember, that's just your little formula on how to calculate deferred tax. And there are, however, 2 exceptions to note. So let us jump in to today's example. How do I use that one? You guys need to watch these videos more so I can get a sponsor and get a proper, fancy whiteboard and whiteboard cleaner. And I don't have to use an old scrapper. Okay, so today's example, we've got B2B investment holdings and they purchase land for 10 baht. Okay, so one thing we know about land is no depreciation, and 2, there are no taxable allowances. So what is our deferred income tax? Well, it's our temporary difference times 27%. That therefore is our carrying amount minus our tax base, which is equal to 10 because there's no depreciation, minus 0 because there's nothing. So that's 10 million. So times 27, that's 2.7 million. However, remember exception number 2, because this has no depreciation, it does not affect our accounting profit, and because there's no taxable allowance, it doesn't affect our taxable income. So as a result, exception number 2 comes here, and we recognize no deferred tax liability. This is just one example of how Back2Basics can simplify the most complex situation.